Let's hear it out then from Saurabh Mukherjee of Marcellus Investment Managers. He believes that the macros and the current earnings look encouraging and it's the best situation for Indian equities in a very long time. Listen in.
Not only are they reporting operating margins of around 25%, actually operating margins 25%. The staff, the input cost pressures there, the wage inflation pressures that we were seeing last year are gone. You're seeing YOY top line and bottom line, YOY and local currency doing around 15-16%. But most importantly, Nikunj, you're doing, I think, around $10 billion of deal wins. And more generally, if I look across the IT services industry, the deal wins number, deal activity is actually quite solid. What these companies are rightfully doing is they're telling you that, look, 4 banks have gone bust in the Western world in the last month. And naturally, therefore, Western CEOs are circumspect about what they're going to do in the next couple of years. And these are high quality, honest companies. I think TCS and I also reckon Infosys has similar sort of DNA. These are high quality, honest companies, and they're tempering down expectations of the future. You and I all just have to use our common sense and say, if we expect Western banks to keep going bust ad infinitum, then obviously life gets difficult for the Indian IT services companies. But I don't think the Western bankruptcy situation for big banks is a permanent situation. Once the Fed starts cooling off rates, the whole mark to market around their bond portfolios fades away, and the long term trajectory that we have seen from TCS, Infosys, I think we get back to that. So the migration to clouds isn't even 1/3 done for the Western world. Their issues, the big global companies' issues with IT staff shortages continue, and I honestly don't see why people get so worked up about quarter to quarter guidance from companies that have proven themselves over 20, 30 years. You got structural trends with clean companies, well-run companies. Go forth, stay invested and make money for it. Consistent compounder stays a big position. Quick disclaimer, all of these companies, I own them through Marcellus, my parents own them through Marcellus, and our 10,000 clients own them. And we have fairly substantial positions in all the companies that I'm discussing.
Intrigued to know whether there are any new entrants to the Rising Giant portfolio. That's where I see the most interesting and upcoming names.
Right. So no, we haven't added much. We're just concentrating on bulking up further. So Divi's Lab used to be only in CCP, in Consistent Compounders, our large cap portfolio. As I think everybody in the country knows, Divi's Lab halved last year. So through November, December last year, we increased the position in Divi's Lab very substantially in the flagship portfolio, CCP. But we also added Divi's Lab, Aisha. We also added Divi's Lab to Rising Giants. Rising Giants focuses on companies with $3, $4, $5 billion market cap. And thankfully for our Rising Giants client, Divi's fell so much through last year that it became a mid cap, and we added Divi's to Rising Giants. Barring that, the only other addition has been in our small cap, in our Kings of Capital portfolio, which is a financials portfolio, where we added Prudent Corporate, which is a company which provides a platform to mutual fund distributors and people who sell insurance policies to the mass affluent. I think there are around 25,000 mutual fund distributors and insurance salespeople on their platform. And we think Prudent Corporate is a straightforward play on the financialization of savings, not just at the sort of ET Now viewers level, but also at, say, the more modest strata of Indian society where people are trying to save 2, 3, 4 lakhs a year through either mutual funds or through life insurance.
Let's also discuss some of the interesting mid-small cap names that you've got in the Little Champs portfolio. Moltech, Pack, Poshak, Tarsen, GMM, Pfaudler. What's the outlook? And if you could just revisit some of these stocks.
Sure, let's just go quickly then. So Moltech Packaging, leader in mold packaging. In mold packaging is the sort of packaging you see in high-end FMCG products, say quality walls, ice cream bucket. So Asian Paints, Berger Paints use in mold packaging in their more premium paint offerings. And naturally, therefore, as the paint industry grows, as the premium end of FMCG grows, Moltech Packaging is setting up plants alongside the big paint and big FMCG giants. So they have a niche in this. They're a leader in this. There's a specific technology advantage that they possess in mold packaging. We've interacted extensively with the management since we first bought a stake 4 years ago. We've seen the management raise its game on capital allocation, improve the technology, and we remain very convinced that there's a long-term future for this very interesting small cap company. Poshak is a dominant player in phosgene. So phosgene is an essential industrial chemical, as essential as chlorine. Because this was the chemical at the heart of the Bhopal gas tragedy 40 years ago, it's a controlled substance. The government does not give out new licenses to make phosgene. Poshak, therefore, is a quasi-monopoly. It tripled capacity through 2020. It tripled capacity through those years. And we bought it once we had visibility that the ROCs, the return on capital, had been slowed, had been compressed by the tripling of capacity. And we remain optimistic that as we come out of COVID, as the economy recovers, the demand for the incremental demand for phosgene will be met by Poshak. Barring Poshak, the only other large manufacturer of phosgene is a PSU, where I don't think the competition is going to be credible or sustainable in terms of a Poshak versus PSU situation.